Welcome to this explainer. Today, we're tracking the physical flow of capital in the massive AI boom. We are going to follow the money right from those mind-boggling infrastructure investments, all the way down to why your next smartphone is probably going to cost you a lot more. Seriously, we're looking at a fundamental rewiring of the global economy here. And the numbers? Well, they are absolutely historic. Let's just dive right into this staggering figure. $750 billion. By 2026, the top 5 hyperscalers alone, companies like Amazon, Microsoft, Alphabet, Meta, and Oracle, they're projected to spend $750 billion on capital expenditures, or CapEx. And remember, this isn't software. This is cold, hard cash being poured directly into physical infrastructure. We're talking massive data centers, complex power systems, and the super advanced semiconductors you need to train AI at this insane scale. The sheer momentum here is completely unprecedented. RBC Wealth Management analysis actually shows broad big tech spending effectively doubling in just a couple of years. Going from $256 billion in 2024, surging to an estimated $427 billion in 2025, and then projected to hit a whopping $562 billion by 2026. This is being funded largely by their own massive cash flows, making it one of the absolute fastest and largest spending cycles we've seen in decades. Section 1. The AI spending explosion, changing the business model. This brings us to our first major shift, one that is literally rewriting the rules of the tech industry as we know it. We're witnessing this massive departure from the highly efficient business models of the past decade. Think about it. For years, tech giants scaled using what we call asset-light models. They relied on algorithms, software, network effects, and they really didn't spend much on physical real estate. But today, well, their CapEx to sales ratio has hit a decade high. They are pivoting hard into a highly capital-intensive era that demands massive physical factories and heavy hardware just to keep the AI engine running. And here's where we hit a crucial bottleneck. Roughly 1/3 of all this hyperscaler spending is now being directed solely toward memory chips. You see, while everyone is constantly talking about GPUs, the reality is that those processors are basically useless without advanced high-bandwidth memory, or HBM, to feed them data. This specific type of memory is consuming a massive and rapidly growing slice of the financial pot. Section 2. The Great RAM Shortage, when macro hits micro. Let's look at the physical supply chain and see exactly how billions in corporate spending have a direct, honestly pretty painful ripple effect right down to us everyday consumers. So here's the harsh physical reality. As these AI data centers just voraciously consume specialized memory, they are effectively outbidding consumer markets. The big manufacturers are deliberately shifting their production lines to serve the AI boom. And it leaves traditional DRAM, the standard commodity memory used in our everyday laptops and phones, completely starved for capacity. Tech hardware is supposed to get cheaper over time, right? Well, not anymore. We're seeing the cost of a single 16-gigabit DDR5 chip jump from roughly $6.84 to over $27 in just a matter of months. That completely shatters normal tech deflation cycles. Overall, DRAM prices have surged 683%, and NAND storage prices up 793% since early 2025. Basic memory has suddenly become one of the most expensive commodities on the market. Now, you might be wondering why this matters to you. Well, memory now accounts for about 18% of a new PC's build cost, hitting us directly in the wallet. CyberPower PC reported a 500% jump in RAM costs. Major makers like Dell and Lenovo are signaling double-digit price increases, and smartphone makers like Xiaomi are warning of 20 to 30% retail hikes. It's getting so extreme that Japanese electronic shops are actually rationing RAM purchases like it's 2020 all over again, and distributors are forcing suppliers to bundle memory with motherboards just to stop the panic buying. Crazy, right? And if you're hoping for quick relief, you're going to be waiting a while. Building these advanced fabrication plants, or fabs, takes an immense amount of time and capital. Because of a previous market down cycle, there was severe underinvestment. So now, lead times for new fabs have expanded from around 2 years up to 5 long years. SK Hynix won't have its earliest new megafab online until 2027, and Micron's new Japan facility is expected in 2028. Basically, this supply squeeze is locked in for years. Section 3. Where is the payoff? With so much money flowing unconditionally into infrastructure and costs rising across the board, we really need to pivot our focus from the cost of AI to the actual value it creates. That is the trillion-dollar question right there. Is this massive infrastructure spending actually generating financial returns for the broader economy? Well, Goldman Sachs notes this tech spending adds a solid 1.5 percentage points to total capex growth. But here's the catch. It is currently only expected to convert to a tiny 0.1 to 0.2 percentage points in actual GDP. So there is a glaring, pretty worrying gap between the money going in and the productivity coming out. That disconnect is perfectly captured by a recent global CEO survey. It revealed that 56% of companies saw absolutely zero significant financial benefit from AI in the prior 12 months. Just think about that for a second. More than half of businesses investing in this supposed transformative technology couldn't point to a single dollar of higher revenue or lower costs after a full year of use. Wow. What we're really seeing is a massive growing divide in the corporate world. A PwC study shows that a tiny fraction of organizations, just the top 20%, is currently hoarding 74% of AI's total economic benefits. That means the remaining 80% of companies are just left fighting over the scraps. So, deployment of AI might be nearly universal, but actual financial success is incredibly concentrated. So, what exactly is that top 20% doing differently? Well, the data shows the winners approach AI not just as some trendy cost-cutting tool, but as a deeply integrated catalyst for measurable revenue. First, they focus on product-level design. Second, they target very specific tasks like software development or customer service, where they can measure concrete workflow gains built right in from the start. And crucially, they establish integrated systems and strong leadership alignment before they even try to scale. Section 4. The new investment paradigm. This massive capital spend, the crazy supply chain bottlenecks, and the sharp bifurcation between AI winners and losers, it all requires a complete rethinking of how we approach global investing and traditional market sectors, otherwise known as GICS, or the Global Industry Classification Standard. Traditional approaches using those backward-looking stock classifications are just completely inadequate now. AI isn't just a tech story anymore, folks. It's a massive thematic web. It touches literally everything, from the utility companies providing massive amounts of power to the industrials building out cooling systems, right over to the healthcare companies using AI for precision medicine. Take optical networking, for example. That's the light-based data transmission that's absolutely vital for AI speed. An investor looking only at traditional IT stocks would completely miss Fujikura, a company classified under industrials, even though they are supplying up to $20 billion in fiber optic cables for U.S. data centers. Then you have Landmark Optoelectronics and Lumentum sitting in completely different subsectors, yet all three of these companies are critical pieces of the exact same AI thematic puzzle. When you look at all this chaos, we have to remember that we're actually observing a historical pattern play out here. Just like the build-out of the railroads or the early days of the internet, massive upfront capital must be spent, and supply chains will be heavily stressed, well before the broader economy adopts the technology and really reaps the widespread rewards. As this physical and financial transformation just continues to accelerate, and memory shortages ripple all the way down to the smart devices right in your pocket, here is the ultimate question you should take away from this explainer today. When the AI productivity dividend finally arrives, will it remain concentrated in the hands of that top 20%? Or will the rest of the global economy figure out how to turn this massive capital cascade into real, lasting value? Thanks for joining me today.